This is often tricky because we're mixing a balance sheet concept with an income statement concept. So normally when we think of free cash flow, we're thinking of something that looks a lot like an income statement. It has revenues, expenses, etc. However, it also has to account for changes in the balance sheet, specifically working capital. Working capital, as you recall, is current assets minus current liabilities. Current assets are those assets that probably have to grow as we grow a business. Things like cash or receivables or inventory are all items that will grow as you grow your business. Current liabilities are those liabilities that are the normal course. So it could be vendors giving you time to pay them, or it could be just a normal flow of wages where people may be on timesheets and there's a little lag there. So those are current assets and liabilities. And a couple of important observations. We want to make sure we can carry inventory or receivables so that that supports our growth. If we didn't allow ourselves some capital to do both increase inventories and carry receivables, we would actually slow down our growth rate. So the idea is we want to look at the investments necessary to sustain our growth rate. And also we need working capital to start a business. You can't start a business with zero inventory if you need it to sell. So be very careful at the beginning of the life of a project to make sure you have enough initial working capital. The other thing to notice is if we go from years 1 to 2 to 3 to 4, working capital will increase because as we grow sales, we'll need more inventory and more receivables. And at the end of the period, remember that you get all your money back. The way to remember this is at the end of the project, whatever leftover receivables are there, assume that we're able to collect those from our customers, and that would be positive cash flow. Also, in inventory, assume that whatever inventory is left over, that we will be able to sell it off and recoup our money. And finally, at the end of the life of the project, we'll pay off all our bills. So all the current liabilities will be extinguished. The easy way to think about this is to say whatever working capital we've accumulated up until the final year, assume that we get it all back in that year. So that's some observations about working capital. The other aspect is if we know working capital for a given year, and that year could be 1, 2, 3, or 4, that's not the free cash flow impact. The cash flow impact is equal to the change in working capital. So let's say we start with $1,000 of working capital in year 1, and next year it grows to $1,500. We don't have to buy $1,500 worth of working capital assets next year because we already bought 1,000 last year. The extra we have to buy would be 500. So remember that it's not the whole amount of working capital that we have on the cash flow statement, it's the increment. What is the increase in working capital necessary to support the growth of the company? We'll show that in an example here, and then we'll factor it completely in our analysis. All right, before we jump into the Excel, let's point out a couple things about working capital. First, the whole idea of working capital is you need to have it in place before you start your business because you need inventory, you need to be able to carry receivables, or you won't be able to kick off your company. So we see that here in this bottom comment is that at the beginning, at time 0, we need to know the amount necessary for covering us for the following year. So we need to look at that for the beginning working capital and at year end for each of the 4 years. And again, we'll measure the net change, which is the impact. So let's start out. So let's start with sales price. Sales price we're given. Initially, the price is going to be $200 right here. We're also told that there's inflation, and then all items have an inflation rate of 3%. So the price will increase by 3%. So it's plus 200 times, open parens, 1 plus inflation rate of 3%. And we'll lock that with an F4. And that means it goes from 200 to 206. That sounds like 3%. Copy that to the next 2 years. So the units sold is stable at 1250. So we'll do that is the same for the 4 years. So total sales equals the sales price times the units sold. And that formula we can copy across. Now we get to working capital required for that year. So and we're given that percentage, and that stays the same for each year. Now it's very likely that that would change over time. But let's just keep that as is. In year one, we need 12% times 250. And we have that for each of the years. The reason I was explicit is if we need 30,000 for the year one, we need to have it on hand at the beginning of year one. So here there's going to be a net increase, which means we have 30,000 that we need to start off the business. So the next year we need an extra amount of 900, which is 30,900 minus what we had this year. So we have to add 900, so it's 30 plus 9 is 30,900. And we do that same item for year 2 and year 3. Year 4 is a little bit different because we will enter the year with a certain amount, but at the end of the year, we're going to get back all our money. So we're going to actually do a negative, and we'll do the sum of all the money we put in, which is the 32,792 or 79782. And to test it, it should equal 0. So sum that back to T0, it's 0, right? So what this means is we put in 30,000 at the beginning, and then every year we have to kick in a little bit more just to keep the business growing. But at the end of year 4, we're going to draw down all of our assets and turn it into cash, and we're going to pay off all our liabilities and clear the decks of any remaining obligations. So that's how we handle working capital. So next we're going to look at the whole picture.